Hi everyone, it's Grace. Welcome back to my channel. In the last two videos, I talked about two of the most important indicators of the status of the housing market. The first one is loan to value ratio, which is basically the liabilities to assets ratio of a residential property of average households at the current moment. The second one is the foreclosure rate, which tells us how many properties are underwater right now. Both of the indicators are hitting historical low, so make sure to check out those two videos here before today's video. Before we begin, remember to subscribe to my channel and click on the bell button so you'll get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. In today's video, I will explore other rate indicators which have significant impact on the economy as well as the housing market. In the last day of March, there has been a lot of news that the market yield between 10-year and 2-year treasury securities has a brief inversion moment, meaning that the spread between the two becomes negative. When it turns negative, it's called an inversion, and it's often treated as a signal for recession. The mechanism is more complicated than this, but to use simple language, it basically means that the short-term interest rate, whether it's the cost of lending between business or banks or among banks themselves, is getting higher. And economic activities will slow down as a result of the interest rate hike. So that's why inversion is such an important signal for recession. But here's the thing. Is the 10-year, 2-year spread enough to tell us what's happening in the economy right now? I actually looked at other short-term rates such as 1 year or 3 months, which are even shorter terms, and they tell a different story. So let's take a look at the line chart together. The green line is the effective Fed funds rate, blue is 10-year, 1-year spread, orange is 10-year, 2-year spread, and red is 10-year, 3-month spread. You can clearly see that in the recent 3 recessions, all 3 spreads went below zero, and some or all of them lasted quite a bit for several years at approximately the time when the Fed funds rate reached the peak. Right now, only the 10-year, 2-year spread briefly inverted, while the 10-year, 1-year is at 0.74% and 10-year, 3 months is at 1.8%. And the Fed rate hike just started. So it'll be when all 3 spreads become negative that we'll see a full-blown recession. If you remember from the bonus tip from the last video, a recession is not an overnight thing. It's spread out over 4 stages in a period of 6 years in the last recession. Currently, we're at the very beginning of stage 1. It's a process of how the economy slows down. And again, how it develops has a lot to do with what the Federal Reserve does about the Fed funds rate. And we'll talk more about it next week. And then let's take a look at the recent movement of the mortgage rates. Since the first Fed rate hike started on March the 17th from 0.08% to 0.33%, the 30-year fixed rate goes up to 4.67%, the 15-year fixed rate goes up to 3.83%, and 5/1 adjusted rate goes up to 3.5%. So compared to the same time last year, these 3 rates are definitely much lower. But mortgage rate, especially the fixed rates, move according to the 10-year treasury yield than being directly related to the Fed funds rate. So when you're looking at the Fed funds rate, don't forget to look at the 10-year treasury yield. And based on a pattern of the last rate hike cycle, which goes up and down quite a lot, I will not be surprised that the mortgage rates will go down again in the movement of upward choppiness. The sudden mortgage rate hike throughout March is slowing down the original mortgage origination, but it still has no impact on cash buyers. So the housing price doesn't seem to reduce even when the mortgage rates are hiking. So now we're experiencing a period of increasing housing price as well as increasing cost of mortgage. And here's my honest opinion. Because the mortgage rate is so reactive to the Fed rate hike, I think in the FOMC meeting in May, it will probably not go up to 50 basis points. Now I'm making more short-term analysis than long-term because the Fed is being extra cautious and plan as we go. So in this year, I don't see the housing price in general going down, and it will only get higher. The 2 charts in today's video will be published on my website as well as my Tableau profile, so make sure to check them out. So this is pretty much today's video about my thoughts on the yield curve inversion as well as the mortgage rate hike. I know today's video is a little bit short, but I promise there will be a lot more to discuss in the future. As always, thank you very much for watching, and I'll see you on the next one.